Skyler Weinand. He's Chief Investment Officer at the investment firm Regan Capital in Dallas. Just to kick off with the market reaction to this better than expected GDP, it was mooted. Were you surprised?
Yeah, we're seeing bonds up pretty materially. The 10-year Treasury's at about 4.2. Folks are coming out really taking grasp of the higher for longer, but also that consumers and corporations really aren't needing to borrow that much. Leverage is at all-time lows. Corporations are borrowing less today as a percentage of their market value than they really have since 1959. So it's not affecting stocks as much because generally speaking, that's your risk-free rate, and especially looking at the 5 and 10-year Treasury where corporations are borrowing, that's not affecting those corporations and profitability as much as it did, call it, 5 to 10 years ago, as they're not needing to borrow as much money. So stocks are kind of taking this and saying, hey, look, this is actually good news. Folks spending more money on goods and services is good for equities. And so we're seeing this shift back to where good news is good news and bad news is bad news when it comes to unemployment and spending numbers.
It's interesting you say that because another question we always have at the back of our minds is what it says about the unknowns. What does it say about the strength of the US economy amid these fears of a market overvaluation and AI bubble?
Yeah, the AI stories, out there, you have the Mag 7 that are carrying the market, and the stock market obviously is not Main Street. Okay, but it does say when you look at these numbers, 4+% GDP growth, 1% higher than consensus, 50 basis points higher than the prior number. It's saying that the consumer is in aggregate very strong. And add to that tariffs have yet to have a large effect on inflation and not on the economy. That also says that corporations are able to absorb tariffs without affecting inflation in the economy as much as folks might have thought 8 or 9 months ago.
Okay, Skyler, for now, thank you very much for joining us on the program.